Well, the price of crude oil is up today after OPEC Plus agreed to push back its planned December production increase by 1 month. Led by Saudi Arabia, OPEC Plus delayed the output hikes until early next year. For insight and her view of the crude oil market over the next year or so, we're joined by Rebecca Babin, senior energy trader at CIBC Private Wealth. Rebecca, thank you so much for joining us. The market's up today on this news, the oil price is, but should it really have been a surprise that OPEC Plus was going to postpone again these increases to production?
So I think it was a surprise to some, myself included, that they decided to delay bringing back their production. So it was kind of 50-50 split on what traders thought would happen. And I think it's less important about the amount of barrels that they're holding back and more important for the market that the group is remaining very strong and cohesive. There has been this overhang in crude, kind of worrying about OPEC Plus losing their cohesion and going after market share and wanting to unwind their production cuts under any scenario, just to try to win back that market share that they've been losing over the past year. And this move kind of gave the market a sigh of relief. Okay, they're still cohesive. They have the capacity to withhold if they need to, and they see volatility ahead. And I think that sparked a little bit of a relief rally of what we're seeing here, that the group is not changing their course, not changing their tack of supporting the market and kind of price stability and going for market share. I think the other factor, though, today for crude is we do have a potential hurricane brewing, and that has like a 50% chance of impacting Gulf Coast oil supplies. And that's not getting a lot of headlines because we have this OPEC kind of decision. We have some increased rhetoric from Iran about a potential retaliatory strike. But in the background, we also have maybe a potential supply risk that's also kind of influencing prices. And again, the third thing, which is always, I think, the thing that we overlook, is positioning. You know, there's a very, very significant short base in crude oil, a negative sentiment trade that's out there for 2025. And even the slightest bit of headlines in the short term can cause a lot of short covering. And I think that's part of what we're seeing today as well.
You've recently referred to the oil market as hyperventilating, inflating and then deflating on different bits of news, particularly the geopolitical tensions. Expand on that idea.
Well, I think really when you said I have views on the next year or so in your lead up, I really maybe only be able to think about today through the end of the week. I mean, there's just such a tremendous amount of volatility and binary outcomes, whether it's geopolitical or election risk or what OPEC does, that the market kind of breathes in every headline and breathes out. And you might see geopolitical risk premium really kind of expand $3 to $5 on one headline, only to be sucked out the very next day. And I think it just shows you how little conviction there is in the market, as well as how short time horizons have become. There's just not a lot of risk appetite to be wrong in crude right now. So you see each and every headline kind of have these outsized impacts. And it feels a little bit like we're hyperventilating here, not able to kind of see the forest through the trees. But it's understandable given how many moving parts there are kind of driving each and every day in the commodity price. So it feels reactionary, and it is, but the risk thresholds are really tight. And if you're wrong, there's no room for error here when you're trading crude.
Is the lack of conviction in the market perhaps a result of a lackluster setup in terms of supply-demand fundamentals?
100%. I mean, the lack of conviction, I think the general consensus view from the hedge fund community, the macro community, and maybe even the CTAs is they'd like to be short into 2025. We're flipping from a deficit to a surplus. We have demand growth going back to around 1 million to 1.1 million barrels a day, whereas non-OPEC supply growth is coming in at 1.3, right? So it's just, that's not a great scenario for crude. You want to see demand growth outstripping supply growth. So the bias is I want to be short into that because there's a lot of downside risk, and I have a huge amount of spare capacity sitting on the sidelines from OPEC plus. That feels really good. However, we keep getting these shocks and these different events that are kind of causing these outsized spikes. So that is the underpinning of the lack of conviction. And it's hard to have a lot of conviction to play the upside when you know there's this spare capacity out there and that demand doesn't look great. So if you're worried about that geopolitical risk, where do you go? You go to the options market, you buy some upside hedges there. But I really think most of the kind of macro community is looking for rallies to sell to set up for that lackluster 2025 viewpoint.
And your view on trading trading the commodity in terms of price range is sell at above $85 per barrel, buy at below $65 per barrel, correct?
That's right. So I think when we get to that $65 a barrel range, I think we do start to see some opportunities in crude. I think the market's overly bearish. I think there's potential for Chinese demand not to be as horrific as maybe some are projecting. I also think there's a chance for the non-OPEC supply growth not to meet the mark. There's pretty high expectations, and we've already seen Brazil falter this year in terms of meeting expectations. They're on tap to produce another 300,000 barrels a day next year. They've struggled to kind of meet their numbers. There's questions about whether the U.S. can meet their numbers. They always seem to do it. But I think there's a couple pockets here where we could see some outperformance from demand, a little bit of underperformance from supply, and the market's super negative. So you could kind of see that as an opportunity to step in. On the upside, yeah, I think 85, we really run into the point where OPEC Plus is going to want to start to unwind their cuts more aggressively. And that kind of fills the gap on any kind of deficits that the market might be running. So I do kind of stick by the trade is to play the range, not get too greedy, and kind of be quick on your trades in this environment, because every day you walk in, it's a brand new day, new headlines and different reactions. So you can't get married to your trades. You got to stick with it, play your ranges, and be nimble.
You also believe that both presidential hopefuls are bearish for oil, that a Trump victory or a Harris victory is negative for oil. That's an interesting call. Why so?
So I think it's a little bit more neutral in a Harris win. And keep in mind, some of this is predicated on who wins the Senate. If we get a blue sweep versus a red sweep, these outcomes could be different. Under Trump, it's very tricky. He potentially will go after Iranian exports. The question is, how effective will he be? In his previous administration, very effective. Now we have a different kind of playing field. The teapots and the smaller refiners have gotten much more savvy in evading sanctions. So he might not be able to rip 1 million barrels off the market from Iranian exports. We might be looking at something closer to 500,000 barrels he's able to impact. And that could be easily offset by lower demand in a scenario where he increases tariffs significantly. So you net those two things out and you're kind of at neutral. And then you throw in maybe a small increase in U.S. production by opening up some regulatory hurdles. And you kind of get yourself in a place where, I don't know, he's not super bullish. And I'm really worried about what happens to the global economy in a tariff environment. And I kind of think you're sitting in a more negative kind of outlook. And I think the market is at that point as well and agrees. With Harris, it's more of a status quo. You might get a higher probability of a ceasefire, but you also might not see the same impact on demand growth. So I see that as a little more neutral, but then we trade back to fundamentals, which don't look good in 2025. So I think it kind of tilts a little bit bearish.